Let us begin our third chapter, a typology of financial markets.
So let's make a list of the financial markets, also known as typology. To begin with, the capital markets, which consist of stock markets which provide financing through the issuance of shares or common stock, bond markets, which provide financing through the issuance of bonds, bonds being debts. Then the commodity markets, which facilitate the trading of commodities. The money and interbank lending markets, which provides short-term debt financing and investments for financial institutions. Derivative markets, which provide instruments for the management of financial risk under the shape of contracts. The future markets, which provide standardized forward contracts for trading products. Foreign exchange markets, which is the trading of currencies. The newcomer cryptocurrency market, which facilitate the trading of digital assets and financial technologies. And we'll also talk about private equity and how it works. The capital markets. They refer to the places where savings and investments are moved between suppliers of capital and those who are in need of capital. Capital markets consist of the primary market, where new securities are issued and sold, typically an initial public offering or IPO. This is when a company enters the market and sells their shares. And the secondary market, where already issued securities are traded between investors. The second one being, of course, the most important. Here is a list of the top major stock exchange in 2022. If you look closer, you will see that the biggest still remain the two Americans, New York Stock Exchange and NASDAQ, that represent the two of them put together more than all the other stock exchange on this list. Capitalization of both those markets are 24 plus 20, meaning totally $44 trillion. Typically, a stock exchange provides a chart like this one. If you look at the graphic, you will see how the price of Amazon share has evolved in the space of one day, meaning what is the available price and how it changes during a day in the life of a stock exchange. The purpose is to buy or sell Amazon stocks for anyone looking at this chart. Typically, this is the kind of information a company that is listed on a stock exchange is supposed to provide. You have, over a certain period of time, the total revenue, the cost of revenue, and the gross profit, which is the difference between revenue and cost of revenue. Plenty other informations are present here, and at the bottom of the page, the net income, probably the most important, because the net income is going to decide the dividends that are going to be given to the shareholders, meaning those people investing on the stock exchange. Question is now how to measure profitability. Well, financial information are good, but those information are useless if you're not able to measure the earnings or earning per share, also known by their acronym EPS. The EPS is calculated by dividing the net profit by the number of shares and therefore estimate the potential dividends, as the worksheet hereunder demonstrates. A few of the world indices. An index is a statistical measure of change in a representative group of individual data points. The stock exchange indices are composed of a selection of top values from the market members. Dow Jones, the oldest of all existing indices, was created in 1851 and is composed of the values of 30 major American companies. NASDAQ Composite, established in 1971, only quotes technical values, computers and internet-oriented companies. Unlike the Dow Jones, the index groups all companies listed in the NASDAQ. The FTSE 100, also nicknamed the 100 FTSE, gathers 100 top capitalization of London Stock Exchange. In France, the CAC 40, Paris Stock Exchange, created in 1988, groups the top 40 capitalization of the Paris Stock Exchange and is now part of Euronext. Let us move now to the commodity market. A commodity is a market that trades the primary sectors. Commodities are usually traded with two sides. Soft commodities, corn, wheat, cocoa. Hard commodities, oil, gold, and silver. Those markets use contracts. You have forward contracts, which is an agreement between two parties to exchange at a fixed future date a given quantity of a commodity for a specific price, defined when the contract is signed. Future contracts are standardized forward contracts transacted through an exchange. In future contracts, the buyer and the seller stipulate product, grade, quantity, and location, and leave price as the only variable. Commodity markets do not have a place of their own. For most of them, apart from the famous CBTO, Chicago Board of Trade, specialized in the trade of cereals. Close to secrecy market, not really known to the public. The money and interbank lending market. Money market provides short-term funds considering that money is a commodity. Different kinds of instruments are being exchanged in those markets. Treasury bills, commercial paper, bankers' acceptances, deposits, etc. Remember, an instrument is a payment instrument. A coin is an instrument, a bill is an instrument. The money market consists of financial institutions and dealers in money or credit who wish to either borrow or lend. Participants, mainly banks, bank-to-banks, borrow and lend for short periods, typically around 12 months, unlike capital markets working for longer periods of time. Derivative and future markets, what are they? The derivative markets is the financial market for derivatives. Financial instruments like future contracts or options are derived. They are derivatives forms of existing assets. In finance, a derivative is a contract that derives its value from the performance of an underlying entity. This underlying entity can be an asset, index, or interest rate, and is often simply called the underlying. In other words, two parties sign a contract at a given moment, agreeing that one pays the other on the basis of the involvement. For instance, two companies decide to exchange two stocks with different rates for a limited period of time. This is what they put in their contract. This means that during this period of time, each company will pay themselves on the base of the agreed rate. The foreign exchange market is the market where currencies are exchanged. It's called Forex or FX. It's a global and decentralized market for the trading of currencies. Main actors of this market are the international banks. It deals with over 8 trillion US dollars in 2022, which is immense and by far the most liquid of all markets. To this day, if you look at those graphics here under, you will see that the US dollar and the euro remain the most traded currencies. The forex offers plenty of advantages that explain its success: risk management, quick liquidity, regulation, advantages of volatility. The newcomer on the financial markets are the cryptocurrency. Cryptocurrency is a digital asset designed to work as a medium of exchange, wherein individual coin ownership records are stored in a ledger existing in the form of a computerized database. In other words, the small pig in which you keep your money is online. Cryptocurrencies are used primarily outside existing banking and governmental institutions and are exchanged over the internet. There are several types of cryptocurrencies: altcoin, crypto token, and the famous Bitcoin. Well, they haven't proved their efficiency so far. American billionaire Warren Buffett called them rat poison, and to this day, unfortunately, he was right. But what happens when companies are not on financial markets, those open, those public? Well, this is named private equity. Private equity are the companies worth investing that are not public, not listed on the stock exchange. Investment funds for investing into them are created and named private equity funds. There are several kinds of them. Seed capital funds for companies usually in high tech that are not making money yet or very little. Capital innovation, investment in companies that have a strong potential for technical innovations. Capital development for companies that have matured activities and wish to grow further. Turnaround for those companies on the edge of bankruptcy, but that can start all over again with a capital increase. Private equity operations. Private equity conduct mainly, but not only, two kinds of operations. MBO, or management buyout, when a fund helps a management team to buy the company they run. LBO, leverage buyout, is one company's acquisition of another company using a significant amount of borrowed money to meet the cost of acquisition. The purpose for the investor is to obtain a significant gain after some years. The world is full of private equity funds, but let's look at a few major of them. The size of a fund is measured by the assets they possess or the capital they possess within a company. This is named AUM, or Assets Under Management. Blackstone, for instance, in 2020 had 8 billion US dollars of assets under management. Our next chapter will be the world of bank and banking.